What if the internet almost completely collapsed before becoming essential to modern life during the financial dot-com crash? In the late 1990s, investors strongly believed the internet would instantly rewrite the entire global economic system. Capital rapidly poured into nearly any company that ended its name with .com, regardless of fundamentals. Profitability was openly ignored because explosive growth alone defined what investors considered real success. The sound of dial-up modems signaled entry into a powerful and historic digital future few people truly understood. AOL, Yahoo, and Netscape positioned the browser as a vast digital frontier filled with commercial opportunity. Wall Street interpreted rising online traffic as guaranteed exponential revenue, ignoring underlying financial risk. Venture capital aggressively funded bold ideas long before their business models were tested or proven profitable. Company valuations expanded dramatically, far faster than their actual products or services could realistically mature. Startups promised to simultaneously disrupt retail, pet supplies, groceries, banking, and nearly every traditional industry. The NASDAQ climbed aggressively, reflecting inflated expectations and mounting speculative risk across technology markets. Initial public offerings converted optimistic projections into instant paper wealth for founders and early investors. Financial media reinforced the narrative of unstoppable digital transformation, amplifying confidence while downplaying risk. Retail investors entered markets through new online trading platforms, fueling rapid speculation in tech stocks. Almost no one paused to verify whether these companies had sustainable revenue, real profits, or stable long-term models. By 1999, skepticism sounded outdated, and any resistance to the internet boom seemed completely irrational. Super Bowl advertisements promoted flashy websites that lacked functioning infrastructure or sustainable business foundations. Marketing expenses expanded aggressively, while operating margins remained deeply negative across most dot-com companies. Burn rate became a symbol of bold ambition across Silicon Valley, rather than a serious warning sign of financial instability. Pets.com aggressively scaled distribution, while selling 50-pound bags of pet food below cost just to grow. Webvan invested billions into massive logistics infrastructure before proving that real customer demand even existed. E-commerce firms prioritized market share, sacrificing operational discipline and basic financial control for rapid growth. The NASDAQ quadrupled within 5 years, driven by excessive speculation and overvaluation in the dot-com sector. Online trading platforms dramatically increased speculative participation, enabling retail investors to flood the market with orders. Message boards amplified irrational optimism, spreading hype faster than any financial report or analysis could keep up. Office spaces symbolized excess, with lavish perks that prioritized comfort over productivity and operational efficiency. User growth metrics replaced profitability as the dominant benchmark, with revenue trailing behind in importance. Analysts introduced jargon that masked the underlying structural weaknesses, distracting from real financial risks. Boardrooms echoed one reassuring phrase: "This time is different," masking the reality of unsustainable growth. History rarely supports rapid expansion detached from solid economic fundamentals, and this time was no exception. On March 10, 2000, the NASDAQ reached its all-time high, marking the peak of the dot-com boom. Market sentiment reflected unwavering confidence in digital expansion, with tech stocks surging despite fundamental risks. Quarterly reports began to reveal increasing operational losses, signaling a dangerous shift in market fundamentals. Forecasts were revised downward as liquidity pressures intensified, signaling a looming market correction and potential collapse. Investors reintroduced profitability as the primary metric, focusing on sustainable growth over speculative market hype. Traffic numbers no longer justified unsustainable valuations, exposing the gap between market hype and economic reality. Capital began to exit speculative positions cautiously, as investors started to realize the market's unsustainable nature. Price declines rapidly accelerated as selling pressure mounted, signaling an imminent market correction and further losses. Confidence in technology stocks deteriorated sharply as investors grew wary of further losses and market instability. The NASDAQ entered a prolonged correction phase, signaling a deep shift in market structure and investor sentiment. Within 2 years, the NASDAQ declined nearly 78%, erasing years of speculative gains and valuations. Trillions in market value evaporated from balance sheets as companies collapsed and investors faced massive losses. Hundreds of firms declared bankruptcy or liquidated their assets, marking the dramatic end of the dot-com boom. Commercial office infrastructure became underutilized, with vacant spaces reflecting the collapse of the dot-com economy. The narrative of digital inevitability fractured, as the reality of unsustainable business models became undeniable. Media reframed the internet, shifting the narrative from revolution to overvaluation, inflating unrealistic expectations. Venture capital allocations contracted sharply, signaling a significant pullback from speculative investments in the tech sector. Technology hiring pipelines slowed dramatically, as the demand for new talent decreased alongside market instability. Dot-com branding lost credibility in capital markets, as firms failed to prove sustainable business models and profitability. Yet several firms, including Amazon, focused on efficiency and long-term sustainability instead of chasing rapid growth. Amazon concentrated on fulfillment efficiency and refining its cost structure, laying the foundation for future growth. Google refined its search relevance instead of prematurely expanding, focusing on sustainable growth through steady improvements. Google's advertising model aligned search traffic with measurable revenue, turning clicks into sustainable business growth. eBay maintained strong transactional liquidity, focusing on niche marketplaces and connecting buyers and sellers efficiently. These companies demonstrated validated demand, proving their market fit through sustainable revenue generation and customer retention. They controlled expenses relative to revenue, ensuring profitability by aligning costs with consistent revenue inflows. Expansion followed cash generation, as these companies prioritized sustainable growth over speculative investment strategies. Operational discipline replaced promotional narratives, focusing on building stable, long-term business models with financial sustainability. Resilience emerged from disciplined structural economics, with firms adapting to market realities and focusing on steady growth. Sustainable business models outlasted speculative hype, as companies with real value thrived in the long term. The crash preserved an unexpected asset: digital infrastructure, which became the foundation for future innovation. Fiber networks, data centers, and servers remained operational, forming the backbone of the post-crash digital economy. Lower costs enabled new entrants to build efficiently, using existing infrastructure to minimize overhead and accelerate growth. Social platforms leveraged existing bandwidth capacity, scaling user engagement without incurring excessive infrastructure costs. User-generated content scaled rapidly, allowing platforms to grow without the excessive spending seen in earlier years. Mobile computing accelerated internet adoption, breaking desktop limitations and enabling access from anywhere at any time. Smartphones seamlessly integrated internet access into daily routines, making the digital world more accessible than ever. Cloud computing simplified product deployment, enabling faster scaling and reducing the barriers to entry for startups. Digital advertising matured, evolving into a predictable revenue stream, with data-driven models ensuring sustained growth. E-commerce became a primary retail channel, gradually displacing traditional stores and reshaping global consumer behavior. The internet recalibrated under financial constraints, prioritizing sustainable growth and efficiency in a changed market. Capital allocation became more selective, with investors focusing on firms demonstrating real value and sustainable growth potential. Innovation persisted within disciplined frameworks, with firms driving progress while managing risk and ensuring financial stability. Speculative excess turned into maturity, with firms prioritizing profitability and efficiency over unsustainable growth. The internet didn't disappear. It evolved through correction, adapting to a new, more sustainable market reality.